Hello and welcome to the HOA Show, where we discuss the news, problems, trends, and critical issues relating to life in a homeowner association. Join us every episode, and together we'll explore how to survive and thrive in the dizzying world of HOAs.
Hello, and welcome to the HOA Show. I'm your host, Ryan Gazelle, and in this episode, we'll be discussing collections, how your community can best go about getting the money that you're owed. I'm joined today by Erin Maloney and Tim Klein. Erin Maloney is the manager of assessment collection services for the law firm Fiore, Racobs & Powers. She's been a member of the California State Bar since 1991 and is a graduate of UCLA. Go Bruins! She's a member of the College of Community Association Lawyers and an active member of CAI in the Greater Inland Empire chapter, where she's served on the board as well as numerous committees. She's a frequent speaker for CAI and CACM and has authored numerous articles for both organizations. Tim Klein is the CEO and founder of the Klein Agency, which he founded in 1998 to serve almost exclusively the insurance needs of common interest developments. Prior to starting the Klein Agency, Tim ran the largest HOA division in the country for a Los Angeles-based State Farm agency. He holds the prestigious CIRMS designation and has written countless articles and insurance board development courses for CAI. Thank you both for lending your expertise today.
Thank you.
So, Erin, what the heck do we need to know about collections? Because I'll be honest, I don't know much about them.
Well, collections are very important to associations because the money that they collect from their members is their only source of income. So it's the lifeblood of each association. And as we all know, the pandemic has caused people to suffer from economic hardships, and that in turn goes right to the associations because as members are unable to pay their assessment, associations are unable to meet their financial obligations, including operating the common area and paying for expenses like management and insurance. So the Civil Code, the Davis-Sterling Act, gives us numerous provisions that govern how associations go about collecting assessments. First, Civil Code Section 5600 tells us that associations must levy them in an amount sufficient to perform their obligations.
The California Civil Code requires associations to levy special assessments or to levy assessments?
That's right. So the Davis-Sterling Act tells associations what they have to do in addition to their governing documents. And Section 5600 tells them that they need to levy assessments from their members in an amount sufficient to meet all of those obligations. So they can't impose an assessment that exceeds the amount necessary to defray the cost for which it's levied, but they also need to make sure that they are budgeting adequately to meet all of the obligations. In this time of coronavirus, it's probably a good idea for associations to expect more delinquencies from their members. They probably need to budget a little bit for bad debt, thereby increasing their assessments for the year, even though it's tough on the members because they have to still meet their obligation. Unfortunately, associations can't apply for a small business loan, so association assessments are the only source of money that they have, and they need to get it from the members.
So what I'm hearing from you is that they have to collect enough money to balance their budget, essentially. They don't have to collect more than a balanced budget.
Right. So they need to collect enough to handle all of their operating expenses and to put money away in the reserves pursuant to what their reserve study tells them they need to do.
Got it.
Erin, is there anything that has taken place in terms of the governor of California that might cause associations to have to forgive owners that are late on their homeowners' dues?
Some associations have reacted to the pandemic by forgiving assessments, but I don't think that's a good idea because they don't have another way to raise the money that they need. So assuming that their budget that they adopted last year was a good budget, it's going to be difficult for them to say that they don't have the expenses anymore, so they they have a way to forgive assessments. However, if an association had a large amount budgeted for, let's say, pool monitor during the summer, and their pool was closed during the summer because of the pandemic, then they may have additional amounts that they didn't spend, and then they might be in a position where they could forgive a month of assessment. So it really depends on the association's particular situation. Usually, they're not going to have it in their budget to allow for forgiveness of assessment.
And does this civil code requirement extend to special assessments as well, or just the regular assessments?
The civil code addresses special assessments as well. Special assessments come in play if the regular operating assessments aren't sufficient to perform all of the obligations, or there isn't enough budgeted in the reserve or placed in the reserve for the association to meet their obligations for maintaining and preserving the common areas. So then they might need to levy a special assessment against the members, and that needs to be done in accordance with the civil code. If it's more than 5% of the operating budget, then the members are going to need to approve a special assessment. It's best to try and avoid them because most members don't like to vote in favor of assessment.
Shocker.
Right. So, assuming that there are going to be some delinquencies, let's talk about what an association can recover from a delinquent owner. Not only can they recover those regular and special assessments, if they're not paid timely, then they can also recover late charges in accordance to what their CC&Rs say. The Davis-Sterling Act tells us it cannot be more than $10 or 10% of the assessment amount. But if the CC&Rs say it's only $5, you're limited to that $5. It's the amount that is greater that is your max. So the association may incur collection costs in its efforts to collect assessments. Those costs can be either from management or from an attorney or from a trustee who is performing services in relation to a lien and enforcement of a lien for an association. Those collection costs can be recovered from the delinquent owner as long as they're reasonable.
What about interest?
That's the last thing that the association is able to collect from a delinquent owner. There's a cap at 12%, which is higher than a lot of other interest caps, but it's specifically accepted from those other caps, and 12% applies across the board for associations unless their CC&Rs provide for a smaller or a lesser rate, in which case they have to go with the lesser rate. There are a lot of associations that don't regularly include interest in their accounting, but I like to include interest. So if I have an account that I'm collecting on, I will add the interest in accordance with what the CC&Rs and Davis-Sterling Act allow. And I use that as a point of bargaining later because it's really just a soft cost. So it's something that the association may be able to waive in order to assist a member in resolving their delinquency. So I like to have it in there from the get-go.
Now, Erin, obviously you've mentioned that they're required by the Davis-Sterling Act, the Civil Code, to collect these assessments. They're also obligated by the CC&Rs, the governing documents as well, right?
That's correct. Yes. Most governing documents are consistent with the CC&R or are consistent with the Davis-Sterling Act, but not all of them. So it's very important for associations to take a look at their CC&Rs and know what they're dealing with. See if it has a smaller interest rate or if it has lesser amount for a late charge, and know that going in. Their collection policy should be consistent with the CC&Rs.
And so it stands to reason that if a board does not pursue collecting these assessments that they're obligated to do, then they could be sued by an owner for failure to adhere and enforce the CC&Rs, correct?
That is exactly right. You don't see those kind of lawsuits very often, but it certainly is possible. And it's one that an association would have a hard time prevailing in if they didn't meet their fiduciary obligations to collect assessments.
Tim, have you seen any claims like that?
We sure have, and it's a really, really frustrating circumstance because, unfortunately, when we see the claims, usually the association has already foreclosed on the unit, and the unit at that point, the unit owner, former unit owner, goes berserk and examines every element of how that collection process was taking place. I understand there's some unfair debt collection responsibilities in terms of the federal law. Is that true, Aaron?
Yeah, there's the Federal Fair Debt Collection Practices Act that the association needs to adhere to in regard to collecting assessments. There's also a state law that's called the Rosenthal Fair Debt Collection Practices Act. And while the federal act applies only to third parties collecting the debt of another, so a managing agent, an attorney, or a trustee would be required to follow the Fair Debt Collection Practices Act. But even if an association is self-managed and is collecting its own assessments, it's obligated to comply with the Rosenthal Fair Debt Collection Practices Act. So they still need to make disclosures and make sure that they're complying with the act in every regard. Even the smallest violation can result in that debt being uncollectible, and it can result in penalties against the association.
So essentially, you need to have a law firm or an attorney walking you through this process because it's fraught with danger.
Exactly. And there's new changes to California law, which are making it even harder beginning in January of 2022. Then they're going to be requiring any person or entity that collects a debt to require a debt collector's license. So even an association that is self-managed that collects its own assessment is going to need to be licensed as a debt collector in order to continue collecting assessments.
And that's effective January 2021, you said?
January 2022.
22.
So we have a year to get up to speed on that, but licenses are going to be required starting in just over a year for any entity or person that is collecting assessments for an association.
Are those licenses that are most likely already maintained by law firms or organizations that specialize in this?
No, it's a brand new law, so they don't even have the structure in place to get the licenses. They've formed committees and bureaus, and they will be creating rules and procedures for obtaining the licenses. Right now, we just have the brand new law that tells us it's coming down the pike.
So at what point should an association involve a law firm or legal counsel to take them through these steps?
That's an excellent question. I think that it's great for an association to start with the initial, hey, you're late letter. Just a friendly reminder, as it were, for the member to wake up and say, oh, I'm delinquent and here's my money if they're able to pay. But if they don't respond to that and the association's going to start thinking about recording a lien, that's when they should get a professional involved. The pre-lien process that is required by California law and the debt collection acts that are imposed make it very difficult to go through the lien process. So Civil Code Section 5660 sets forth a bunch of requirements that need to be in your pre-lien demand letter, in addition to requirements about making decisions and recording them adequately in the board's minutes and offering alternative dispute resolution, offering internal dispute resolution. There's many different requirements that need to be met prior to recording a lien. I recommend that an association get an attorney or at least an experienced trustee service involved when it is starting that lien process with the pre-lien letter.
About how often does it usually get to the lien process in your estimation? Would that be, like 50% of the time, 20%?
It depends on the association. Associations, of course, have different demographics of their members. And those members that are harder hit by the pandemic are likely to see a larger delinquency rate right now. So people who were laid off from their job as a waitress or cocktail server or something like that, they're not going to have income to pay their assessments, and they're going to become delinquent. So in associations that are lower class or middle class, they're seeing a lot more delinquencies than those where the CEO is able to work from home. And so the associations with higher property values tend to have more executives that are less delinquent. So depending on the demographic of the association, they're going to have a higher delinquency rate or a lower delinquency rate. But in any case, whenever an association sees a delinquency, it's my recommendation that they act quickly on that delinquency. If they delay collection efforts, they run into problems with statutes of limitations running, or just simply the problem of it being too much money for the owner to be able to come up with to resolve the delinquency. So the earlier an association starts, the easier the collection efforts are.
And so if they tried for a few months and they're unsuccessful, at that point they should reach out for professional guidance.
That's my opinion, and I think most associations do have policies which provide for that. So even if an association or its managing agent does the pre-lien process, recording the lien is something that, again, has a lot more requirements. And it's very, very important that an attorney or another professional help the association out with recording that lien and making sure it's done properly. The lien is really important for an association because if a member files for bankruptcy and a lien is recorded, an association will likely be able to recover amounts through the bankruptcy or after the bankruptcy if that lien is there, because a bankruptcy discharge does not discharge a security interest. So the lien survives the bankruptcy. If it's a Chapter 13 bankruptcy, they have to pay through the bankruptcy to satisfy the lien. Also, if the member decides to sell their home or refinance, the lien is going to appear and it's going to be satisfied through escrow if everything goes right. So liens are really important to get down early.
This kind of begs a question that comes up quite a bit for us in the insurance world. If you've got, say, an earthquake occurs and there's a special assessment to cover the deductible, is there a way to tie that special assessment, say you're not able to collect it and the owner walks away, would it disappear, or could you have that assessment placed, transferred as a lien on the unit, and the bank or the next owner would then be obligated to pay it?
It's important to get special assessments like that into a lien. If it's foreclosed by the first deed of trust holder, that lien might still be extinguished. It's a first in time kind of thing. So if the lien is recorded after the first deed of trust, which it almost always is, then the lien gets extinguished and the bank would not become responsible for the special assessment. But if it is not foreclosed, then the next owner, let's say it's transferred by a regular conventional sale, and for some reason it doesn't go through escrow and isn't caught, then the next owner would take title subject to that lien and would be obligated to pay it. So getting a lien down is very important for especially for a special assessment.
And what are the options for collection?
That's a great question. The Civil Code gives us a few of the options. It's open-ended, but the most common ones are either to pursue the member's personal obligation to pay assessments or the member property's obligation to pay assessments. So or both. If you are just going to pursue the personal obligation, as long as the debt hasn't reached the statutory limit for small claims, then that might be a viable option for an association. But it has its pitfalls. The jurisdictional limit is usually only $2,500, although 2 cases per year can go above $2,500 and up to $5,000. In small claims court, an association cannot pursue foreclosure. So it's foregoing its lien rights if it goes through the small claims process. If a judgment is obtained in small claims and the association has a lien down, it has to release that lien. Otherwise, it's double dipping for that amount. So small claims is great for former owners where you don't want to pursue the lien process or can't because they don't own the property anymore. And it's also great for fines, which cannot be included in a lien. But usually it's not something that I recommend for a current owner because you are foregoing that lien right when you choose the small claims option.
And you're limiting yourself to $5,000, right?
You're limited to the cap. And you cannot use an attorney in small claims court. So you're not going to have attorney's fees in a small claims judgment. Unfortunately, you're going to be enforcing a small claims judgment in the same manner that any other judgment is enforced. And sometimes that's above the pay grade of the people who are getting the small claims judgment for you. And you may need to involve attorneys in trying to do a bank levy or a wage garnishment. But you may not be able to recover those attorneys' fees because they weren't originally included in the judgment, and there's no procedure to add post-judgment attorney's fees to a judgment if that doesn't include attorney's fees in the first instance. So sometimes the enforcement becomes more expensive than the actual judgment. And of course, that's not a good situation.
No.
So the next option for collection is kind of, if that's the left hand, let's go to the right hand, and that's non-judicial foreclosure. In that process, you go through the process of recording a lien, like we discussed earlier. You do a pre-lien demand, then record a lien, and then you go ahead and pursue foreclosure of that lien by using a trustee who's going to conduct an auction similar to how a mortgage usually is foreclosed. A notice of default is recorded and then a notice of sale, etc. This kind of process is really good when equity exists in a home. But in a case where there's no equity and you pursue only the lien, you're foregoing your right to sue someone and collect on the personal obligation. You may just have the owner say, I don't care. I'm underwater anyway. Go ahead and take it. And it's not an effective way of actually getting money into the association's coffers. So an association should be careful to look at the ratio of the debt to the property. Is there equity, and determine whether or not it's really a good, viable option to pursue foreclosure only. In situations where there's no equity, or even if the association just wants to make sure that it's pursuing both avenues of enforcement, the third option is judicial foreclosure. And that's what I specialize in. It's what I think is the best because you get to pursue the lien if that's what you want to do, and you also get to get a money judgment against the owner and pursue them personally if that's what the board wants to do. So your options for enforcement are double of either of the other procedures. You can go ahead and levy on a bank account if you know that they have money stashed away. Or let's say that the board knows that this member is always dressed in scrubs and has a name tag of the local hospital. So they're going to be able to know where that person is employed, and you can do a wage garnishment to collect the money. And then you wouldn't have to go through the foreclosure process. You can collect the money by enforcing the money judgment. And a money judgment that's obtained by an attorney has attorney's fees in it initially, so you're also able to include post-judgment attorney's fees that are incurred for enforcement in the writ that you obtain. So it's an excellent way of making sure that all of your bases are covered. It can be expensive.
Yeah.
Yeah. If a debtor fights it, if they contest the action by filing an answer, it can get expensive. However, the Davis Sterling Act and most CCNRs allow us to recover reasonable attorney's fees through the course of the litigation. And that reasonableness is not determined on the basis of what the assessment amount is. It's determined on the basis of the work performed. So even if the assessment is only $20 a month and the association files a lien after 6 months and files an action after 12 months of delinquency, and then the owner fights it, the assessments might still be very small, but the attorney's fees suddenly will get high because you're in contested litigation. And that shouldn't affect the judge's determination of what is reasonable for attorney's fees to be awarded when the association prevails. So I've had cases where the assessment amount is under $5,000, but the member fights it so hard and fights in such a egregious way that the attorney's fees can exceed $100,000. And I've been awarded those kinds of high fees and collected them through the process. So an association shouldn't be scared of potential litigation. It should have the right to collect fees as long as they're reasonable.
I guess that kind of begs the question. And I'd imagine a lot of boards would say, well, if it's just $1,000, it's just $2,000, it's not a lot of money. Do we want to spend all this money on attorney's fees in order to try to collect that? Is it worth it?
That's a great question. And I think it is, because if they don't take efforts to collect those assessments, like you said earlier, other members may sue and say, hey, you're not performing your fiduciary duties as you should be. You're not going after all the members for assessments. That could be a problem. Also, like I said earlier, you can run into problems if you later try and collect those assessments and a statute of limitations is run. So as we know, boards change in associations. And if one board is lax and saying, oh, it's just $2,000, we're not going to do anything, and another board comes in a couple of years later, they may not be able to do anything because of a statute of limitations running. So it's important for associations to meet their duty, to go forward and use reasonable efforts to collect assessments from everyone. So another option for collection, in addition to the ones that are discussed in the Civil Code, which is small claims, non-judicial, and judicial foreclosure, is a collection agency. But this is one that I don't really like. First of all, the Davis Sterling Act limits associations' abilities to use them in the first instance. An association is prohibited from assigning the debt to another party. And that's usually how collection agents work. They have you assign the debt to them. And since that is prohibited in regard to current owners, you can't use a collection agency for a current owner. However, you can use a collection agency for former owners, people who the lender has already foreclosed. And that's certainly an option that I think associations should consider instead of just writing off debt that's owed by a former owner. Associations should be aware that collection agents often charge up to 30% of the debt. They keep that and they give you whatever else they're able to collect if it goes above 30%. So you may not ever see the money, but it's better than just writing it off. An association could also use small claims for former owners. So a collection agent isn't the only option in that regard. Now, for all of the types of collection that I've discussed, it's important for associations to consider internal remedies before and during the process. So some of the internal remedies are statements and demand letters. Let's say an association uses coupon books and somebody becomes delinquent. Simply sending them a statement or a demand letter saying, hey, you missed a couple of months, might make them realize that they had misplaced that coupon book and they're behind, and they might just come up and pay before you ever have to get too far in the process. So that should be something that every association does as soon as someone becomes delinquent. There's a lot of governing documents that provide you can suspend privileges and voting rights of members who are delinquent. However, recent changes to the law say that we can no longer suspend members' voting privileges if they're delinquent. Associations can suspend the right to use the pool or the gym or other common area facilities, but they can no longer suspend a member's right to vote just because of a delinquency.
I imagine that right now that wouldn't help a whole lot since most folks can't use the pool anyway.
That's exactly right. That what used to be a great tool of you can't use the pool until you pay didn't really work that well this summer.
Yeah.
Aaron, this is great information. It's really, really interesting stuff. I was wondering if I could just step in just to talk a little bit about some of the insurance ramifications.
Please do.
Thank you. That'd be great.
It's very interesting. When an individual unit owner goes to his agent or broker and tells them that he's bought a condominium unit, the agent or broker is going to write a policy called an HO6 or individual unit owner policy. And one of the provisions, an important provision in the unit owner policy, is a coverage called loss assessment. A loss assessment is often quickly described to the owner, sold at very modest amounts. We always encourage an owner to maintain at least $50,000 or higher, but oftentimes we see as low as $1,000. But the loss assessment coverage is designed to protect against a special assessment, and individual owners are somehow under the impression that covers all special assessments. And unfortunately, that doesn't cover all special assessments. And here's a good example. Most policies that are written for unit owners will only cover special assessments that occur as a result of a peril insured under the individual policy. So if the policy covers fire, explosion, smoke, wind, hail, aircraft, vehicle, only those special assessments would be covered. So we'd see this come up in places where we had a loss and there was not enough building coverage written by the agent who wrote the master policy. So the board had to levy a special assessment to come up with the shortfall. Similarly, it will cover a special assessment due to bodily injury or property damage that occurred as the association's negligence. A slip and fall claim or a drowning in a swimming pool could end up with an award against the association that's greater than the association's limits they maintain. And they have no other alternative but to levy a special assessment. These type of special assessments, however, that are due just to bad debt are likely not going to be covered. I would, however, encourage individual owners to maintain a higher limit and to submit a claim anyway, because we've seen adjusters make mistakes in the past, and they may cover the claim just out of ignorance on their part. But most individual policies will not respond to a special assessment related to a bad debt issue. The other important information that would be, I think, valuable to listeners is the fact that any kind of claim against the board, whether it's small claims or ADR or IDR, dispute resolution issues, you should put your agent or broker on notice regarding that action, because that may at some point in time give rise to a claim under the D&O policy. And if the board has failed to notify the agent or broker, they may find that the insurance carrier will not cover the resulting action because of a late tender, meaning they notified the carrier too late and they prejudiced the claim. I don't think the insurance company will want to come to the ADR or IDR or to the small claims action. Obviously, they can't really do much with the small claims other than to respond. But it's super important that you put them on notice. And this is true with regard to renewals as well. When you renew a D&O policy, you're asked to sign a statement that says that you're not aware of any act, error, or omission which might give rise to a claim under the policy. And you must disclose if you have a dispute with an owner, just so if it does end up being a D&O claim, the carrier can't come back to you and hold you and not cover the resulting action, both the defense and the indemnity, because it was a late tender.
That's a great point, Tim. And I guess I'm curious, at what point would you recommend that the board notify the D&O carrier and put them on notice? If it's just, we've sent out some letters, these people are late in their assessments, or only once an attorney's been involved?
Well, Aaron, correct me if I'm wrong, but my understanding is the California Civil Code allows an individual owner to request mediation. And in that circumstance, that's exactly when this dispute rose to a potential claim. So even though the mediation may be successful or unsuccessful, the fact that an owner requested mediation, in my mind, it says that they're having some question whether or not the board is acting in good faith with regard to this collection of assessments.
Tim, that's really a good point. It actually goes one step further. It's not just that a member can request mediation. There's another procedure that a member might request that's less than mediation called internal dispute resolution. And that's where a member is requesting a meeting with a designated director to discuss a matter that they consider to be a dispute. I would suggest that if a member even proposes IDR, internal dispute resolution, that should be when the insurance carrier is notified, because the member is identifying it as a dispute at that point.
And Tim, towards your point, the reason that you need to notify these D&O carriers and not the general liability carrier is because why?
Well, the general liability policy that the association maintains primarily is bodily injury and property damage coverage only. Doesn't typically cover money damages, and this is a money damage claim. And so, we'd see that what we typically see is, again, we were brought in when, unfortunately, there's been a foreclosure, and then everything is being really examined under the microscope. And it's that point where we're likely to see a claim established. We've already put the carrier on notice, fortunately, so they can't back away from it. But we'll notify them that it actually has become a claim, and then they'll be looking at these items to figure out whether or not they indeed fit the definition of an act or omission under the D&O policy. But it would not be a D&O claim, a general liability claim.
And the D&O carrier could potentially decline the claim because they want to be involved at the beginning.
Yep, this is, I think, the real message for board members in this circumstance is hire a professional. This is much too complex to handle yourself, and Erin, her firm, does an amazing job. And secondly, if you have any question, put your carrier on notice. It doesn't cost you anything to pick up the telephone and say, "Hey, we've got a dispute right now, and I don't want to present a claim, but I do want to put the carrier on notice." That will cover the bases.
With any luck, the association will be able to resolve the dispute without having to go further with litigation or anything, and you'll never have to reach out to the carrier again. It'll be resolved. But you have to go through the process to get to that resolution, and if it isn't resolved, you want that carrier to have been on notice from the get-go. So it's similar with the delinquency issues. You're going to try and resolve the dispute or the delinquency as best you can without having to go through litigation or other processes. So it's my recommendation that associations have established standards for settlement and for payment plans. It's important, again, for associations to look at their governing documents in this regard. There are some CC&Rs out there that say that an association cannot enter into any type of agreement that lasts longer than 12 months. Most of the time, those kind of clauses are limited to particular types of agreements like utilities or something like that. But sometimes it doesn't have that clause, and it's any agreement. A payment plan is an agreement. So if your DCNRs or bylaws say you can't enter an agreement longer than 12 months, an association needs to know that. They can't enter a payment plan longer than 12 months. It's also my recommendation that payment plans stay under 12 months. I usually like a 6-month payment plan because usually if it's longer than that, members tend not to stick to it. It's too much of a burden on them. If you keep your payment plans shorter, first of all, if you take action quicker, then keep your payment plans shorter, you have a better recovery rate for those situations. If you let things go too long where a member says, "Oh, I can't afford to pay this unless I have 20 years to do so," the association is not going to be in a position to give someone a payment plan that long, and they're going to need to go and probably refinance to take care of the debt.
Do most CC&Rs have payment plan guidelines?
No, most CC&Rs do not discuss payment plans. So it's something that a board needs to adopt standards for on its own. And it should publish those standards in its annual disclosure mailing to the members. It can be part of its collection policy, but I like to keep payment plan standards a separate policy because if a board wants to change its collection policy it can do so, and it's not a change to its operating rule. However, a standards for payment plans is considered an operating rule, and if a change to those standards is being made, it has to go out to the membership for a comment before it can be adopted. So having standards as a separate standalone policy is a good idea for an association. Once standards are established, it's important for the association to give that to their attorney or other collection vendor so that the vendor knows or the attorney knows what those parameters are for settlement. Even if a board has not adopted official standards, they should meet and figure out what they're going to allow their attorney to do in regard to payment plans for accounts that have been turned over to the attorney. So if they in advance tell the attorney, you're authorized to enter into a payment plan up to 6 months as long as it provides the full amount of payment, full payment of the full amount of the debt, then the attorney doesn't need to go back to the board, wait a couple of months for the payment plan to be approved. It has that standing approval and can enter into an agreement quickly with the delinquent member. So having those standards in place is a really good idea.
And what about settlements and waivers?
That's a similar kind of idea. Typically, it's my advice that if you're going to allow a member to go into a payment plan, you should not waive any amounts. You're allowing them the benefit of paying over time, so they should have to pay the full amount. But let's say that they're able to come up with a lump sum that's less than the full amount of the debt. Should a board consider waiving a portion of the debt in order to settle the case? And I think that it's a good policy for associations to consider some waivers, but some are too much. So waiving interest, great idea. That's a soft cost. Perhaps late charges are a soft cost as well, and you might want to waive those. But hard costs, which are the assessments and the collection costs and the attorney's fees, those shouldn't be waived, because if you do that, you're putting the burden of those costs that have been paid or budgeted for on the other members who are paying members of the association. So assessments might increase across the board if you do too many waivers for the delinquent members. So I usually like to keep waivers to soft cost waiver, interest and late charges. And I like to say, okay, if you're going to get that waiver, you've got to pay it quickly. So don't waive amounts and say, oh, you pay that in a year. That's silly. Say, great, we'll waive the interest, we'll waive the late charges, but you have to pay in 10 days. I think that that makes sure that the income comes in a timely manner and is most beneficial for the association and for all of the members of the association. As far as former owners, that's a different story. Let's say that an owner has already lost title to the property, their lender has foreclosed, and the association has perhaps started a small claims action against them, and they now want to reach a settlement. Since they're former owners, you can be a little bit more lenient with the amount because it's not impacting the other members of the association nearly as much. So an association might consider collecting only 50% of what is owed, hopefully more, but it can consider a bigger waiver if the member is a former owner.
Aaron, I have a question with regard to earthquake special assessments, because this is an interesting issue to me. With regard to the first mortgage holder and their ability to foreclose, and they have a primary position, as I understand it. So in the Northridge earthquake, whether or not the associations had earthquake coverage or not, there was still special assessments, primarily because the deductibles, of course, generated values that were far greater than what they had in reserves. So when the special assessments came out, some owners who were upside down in their units, decided this is a good time to walk away from what was otherwise a bad investment for them. And the association foreclosed, and then the association waited for a couple of months for finally the bank to foreclose. And the challenge, of course, was the timing of the special assessment with regard to the earthquake claim, because they wanted to give the owners adequate time to collect the money, put the money together, liquidate resources or investments, whatever is necessary to get the money. But they also realized that if they levied the special assessment before the bank foreclosed, then the bank would not be responsible for that special assessment amount. Is that still correct?
Yeah, it's a game that you have to play. You have to levy the assessment soon as you know that you have the obligation and there's no other way to meet the obligation. But if the members are walking away, it's kind of better to levy the assessment when the banks are there because they have resources. Let's say that the assessment is levied early and all those owners walk away. That's when associations start looking at, gee, we can't afford to make the repairs that are necessary as a result of the earthquake. And an association might consider walking away from the project and going into bankruptcy or other forms of dissolving the association. Most CC&Rs provide for how that's done, and it's a very difficult process. It's something that, if an association is faced with, they definitely should hire experienced attorneys and experienced insurance professionals to get through and make recommendations on what do we do now after a disaster.
You know, what I thought was interesting, and I kind of heard this through the grapevine, is there were some attorneys that were trying to find a creative way that if the special assessment occurred prior to the bank taking ownership, that they could still get the money from the bank. And so I heard that there was an option where when the unit owner got the special assessment, they could pay the full special assessment, or the association could borrow from the SBA. And of course, the SBA only offered up to $1.5 million at 4 to 5% interest, amortized over 20 years. But they would use that $1.5 million to cover circumstances where owners walked away. And then they would place a lien on that unit every month equal to a proportionate amount that the unit owner owed. And the reason they did that was that would tie the bank into being responsible for paying the SBA loan. Does that make any sense to you?
That's exactly right. It makes sense. And like you said, it's very creative. I think that's why associations would need to consult a professional to think of those kinds of creative solutions. Of course, the more creative you get, the more it's subject to challenge.
Yeah, of course.
It's definitely something that associations need to get professionals involved so that they can work through the process and hopefully survive it.
You know, one of the things that I like about CAI is we get a chance to actually have some input on some of these issues, both locally and sometimes nationally. And the people that seem to really have the most influence in terms of these insurance provisions and what happens after an earthquake is Fannie Mae and Ginnie Mae, both of which don't require earthquake coverage. But what I think is interesting is that they say that about 10% of the owners in impacted buildings put their key in the envelope and mailed it back to the bank and walked away from their investment. I know that would vary depending on how much equity owners have, whether or not they chose to walk away or they chose to stay in the unit. But if you imagine 10% of your income, or in this case, 10% of the special assessment that you're trying to raise to rebuild wasn't recoverable, it'd be really very challenging. And so I just really tip my hat to those attorneys that are so creative. And I again think that if you fail to get legal counsel in this area, you're really a fool because it's such a complex issue.
It is a very complex issue and hopefully one that not too many associations have to deal with.
To summarize what I've learned from you today, Erin, and thank you so much, and Tim, first, the board is required to collect assessments by the California Civil Code and the CC&Rs. And second, the first steps are to try to be reasonable, send letters, send reminders. The third step, seek legal counsel because all the I's need to be dotted, all the T's need to be crossed, and if they're not, you could get in serious trouble. 4, notify the D&O carrier if it gets to the point where the owner is disputing the assessments that you're trying to collect via IDR or something along those lines. Number 5, record payment plans. If you don't have one, make sure that the board gets one in place. And number 6, remember that you're setting a precedent. Whatever steps you take, going to be recognized later and evaluated and scrutinized. Does that sound about right?
That sounds about right.
Erin, how can our listeners reach you or learn more about collections from you?
Well, the easiest way to reach me is through my website, which is fiorelaw.com. That's FIORELAW.com. And you can click it on my email and reach me directly through the website. And the website also has articles that myself and other members of my firm have written. So your question might be answered just by perusing those articles.
Great. Well, that's our show for today. Special thanks to our experts, Aaron Maloney and Tim Klein, for their time and wisdom. As we end our episode, we'd like to remind our listeners that if you have any comments, questions, or suggestions for topics you'd like to learn about, you can email us at feedback@hoashow.org. Join us next time on The HOA Show.
To share or subscribe to the HOA Show, visit us at hoashow.org. There, you'll be able to listen to other episodes, find helpful resources relating to HOAs, provide feedback, submit questions, and check out other great stuff. The HOA Show podcast has been made possible by the contributions of Klein Agency Insurance Brokers, leaders in the community association industry. The views and opinions expressed by the podcast, its presenters and guests, do not constitute legal advice. For more information on how the topics in discussion apply to you, please consult with your own legal counsel.